attorney Laura Anthony, founding partner of Legal and Compliance, a full-service corporate securities and business transactions law firm. Today is a continuation in a LawCast series talking about direct public listings. I have been going through the direct listing process for trading on OTC markets. Ultimately, a company will be registering common stock, and that common stock will trade on the OTC markets. But the initial private placement investment itself can take many forms, including convertible preferred stock, units consisting of current equity in the form of common and/or preferred stock and options or warrants, or units consisting of any combination of debt and equity. Private offerings often include registration rights agreements to require the company to file a resale registration statement within a certain period of time, and even to pursue a trading symbol and listing on the OTC markets. In structuring the private offering or offerings and subsequent resale registration statement, thought must be given to the public trading markets, including obtaining a trading symbol, qualifying for various tiers of OTC markets, such as the OTCQB or OTCQX, and hopefully having an active trading market. Part of this process includes planning for the Form 211 application, which will be filed by a market maker after effectiveness of the S1 registration statement. When reviewing a market maker's Form 211 application for the issuance of a trading symbol, FINRA conducts an in-depth review of the company, its shareholders, and capitalization. One matter which FINRA reviews in determining whether to grant a trading symbol is concentration of ownership. FINRA will not grant a trading symbol unless there are enough non-affiliated shareholders holding freely tradable shares to establish a public float. Although there is no particular rule on this, my experience indicates that an initial float must be comprised of a minimum of 30 shareholders, with more being better. FINRA will also consider the percentage of the company owned by these non-affiliated shareholders. Again, although there is no hard rule, in order to obtain a trading symbol, at least 20% or greater of the company's common stock on a fully diluted basis should be in the hands of the public float. Likewise, OTC Markets now considers concentration of ownership in determining whether to grant an application to trade on the OTCQB or OTCQX tiers. OTC Markets generally follows the same parameters as FINRA, though if other red flags or negative factors exist, such as recent shell company status or questionable current shell company status, at least 25 to 30% of the company's common stock on a fully diluted basis will need to be in the hands of the public float in order to trade on these higher tiers. Furthermore, counsel must be sure to assist with any blue sky compliance in the entire process. Once all private offerings are completed and the company has its intended capital structure and number of shareholders, and the company audit is completed, the S1 registration statement will be drafted and filed with the SEC. A company can choose to file confidentially, but will need to make all filings public at least 15 days prior to the registration statement becoming effective. Within 30 days of the filing of the S1 registration statement, the company will receive initial comments from the SEC. The comment and review process will continue with the SEC for approximately 3 to 4 months, at which time the SEC will clear the S1 and it will be declared effective. When a company is trading on a national exchange, they have generally timed the application with the exchange so that the shares begin trading shortly after the S1 is declared effective, and in particular, upon filing an effectiveness of a Form 8A to complete the full registration process for the company. A Form 8A will be discussed later in this LawCast series. In an OTC Markets listing, a Form 211 application must be filed with FINRA to receive a ticker symbol and begin trading. The Form 211 is filed by a market maker. Generally, a company will begin to speak with a market maker shortly before the filing of the Form 211. The FINRA process will take a minimum of 2 weeks and can go on for several months. Preparation of an organized and complete file will make a big difference in the timing of this process. Concurrent with the Form 211 process, the company will apply to OTC Markets and determine which tier it qualifies for. Once FINRA issues a ticker symbol, the company can trade. However, to gain liquidity, the company will also need to obtain DTC eligibility. The market maker that assists with the Form 211 application can generally submit the DTC application as well. The stockholders listed in the S-1 registration statement are then free to sell their registered shares at the price registered with the SEC. I'm securities attorney Laura Anthony, founding partner of Legal and Compliance and producer of Lawcast. Should you have any questions about today's topic, please visit securitieslawblog.com and lawcast.com or contact me directly. Inquiries of a technical nature are always encouraged.